Hello, this is Japanese Economic Review Channel. Today, we will analyze the June 2026 Corporate Goods Price Index Flash Report published by the Bank of Japan. We will explore the current inflation trends and the structural factors currently impacting the Japanese economy. Let's overview the key indices. The domestic CGPI rose 7.1% year-on-year to 135.4. Crucially, while contract basis import prices increased by 17.8%, the yen basis import price index surged by a staggering 29.7%, reaching 196.6. This chart illustrates the trend since 2020. The yellow line shows import prices nearly doubling to 196.6. Meanwhile, the domestic index, the dark blue line, remains at 135.4. This massive gap highlights the unpassed costs Japanese companies are absorbing. The primary driver of this gap is the historic exchange rate of 160 yen and 80 sen per dollar. The striped areas show the pure currency depreciation penalty. This extreme yen weakness acts as an aggressive multiplier, severely amplifying the cost pressures on domestic prices. Examining the domestic CGPI, the index sits at 135.4, meaning prices are over 35% higher than the 2020 baseline. With a plus 7.1% YoY and plus 0.4% MOM growth, this upward trend is heavily driven by sustained pressures in energy and basic materials. Looking at the MOM domestic drivers, agricultural prices provided some relief, dropping by 0.11%. However, this was entirely offset by rising energy costs, specifically petroleum and coal products, plus 0.21%, and power, gas, and water, plus 0.09%. Next is the export price index and its currency inversion. Global contract prices for Japanese exports slightly fell by 0.4% MOM. Yet, the exchange rate mechanics absorbed this drop, resulting in a net positive return of plus 0.4% in yen terms. Breaking down the export index on a contract basis, diesel and jet fuels fell by 0.52%, and metals dropped by 0.20%. Conversely, electrical and electronic equipment, including semiconductors, was the sole major upward force, rising by 0.44%. Returning to the import price index, it acts as the main inflation engine. Approaching a 100% increase since 2020 at 196.6, import costs remain the most aggressive vector for domestic inflation, compounding pressures from both global prices and FX. Interestingly, global energy contract prices cooled in June, with petroleum and coal dropping by 0.32%. However, this foundational relief was heavily offset by rising imported tech hardware, plus 0.18%, and metals, plus 0.12%. This matrix compares sector impacts across indices. While global energy prices cooled, domestic utility prices are still catching up. Meanwhile, tech hardware remains universally inflationary, exerting upward pressure across domestic, export, and import markets. In conclusion, global contract prices show some stabilization, but the FX multiplier amplifies a plus 0.1% contract import rise into a plus 1.3% yen basis surge. This ensures severe inflationary pressure pipelines directly into the domestic ecosystem, locking in higher prices. Thank you for watching the Japanese Economic Review. We look forward to having you with us again.